Prospects of making 105% in a single month using a systematic strategy that trades on daily timeframes sounds great, doesn't it? Strategy I'm currently testing made such gain and generated this equity curve that we're looking at here on this screen. Now, looking at the monthly profit table, we can see that this strategy made just over 105% in March 2020 and actually ended the full year at just shy of 125% profit. This indeed sounds amazing and is something that most beginners and inexperienced traders would just take and start trading without further validating it. A repeating pattern that I see among less experienced traders is that they tend to think in binary terms. For example, when looking at the performance of a trading strategy, they tend to focus on the profit potential only and failing to think about anything else, namely the risk of the strategy. I can see this in some of the comments here on YouTube on some of my videos where I share some trading strategies alongside their performance, where often I get comments saying that the return is simply too small. Now, the reality is that the return of a trading strategy is only one element in the equation and should never be viewed in isolation. When assessing trading strategy, other elements have to be taken into the account as well, namely its risk, but also the time requirements of a given strategy or style, its practical viability, and so on. The strategy that generated this 105% monthly gain is a great example of how focusing solely on profits can potentially cause a huge drawdown and a lot of stress. Firstly, let's have a look at the trade that contributed heavily towards this stellar month. This system made a number of successive profitable trades in March 2020, where the greatest profit was generated by the highlighted trade, specifically entry on 18th of March 2020, resulting in a profit of just over 182%. So let's have a look. To roughly describe this strategy, it's an aggressive mean reversion system that I'm currently working on as a part of my project, where I'm developing a number of aggressive mean reversion strategies with a view of trading these simultaneously in a small aggressive portfolio. This particular strategy trades volatile and less liquid stocks that are part of Russell 3000 index. And what it does is it waits for the market to make a considerable move, which is what I measure by a certain multiple of the standard deviation of the daily rate of change, where the strategy then aims to enter below the market using limit orders. Now, if you're looking for inspiration for your own systematic trading, then I highly recommend that you start looking into using limit orders to enter instead of entering at market. This technique has a great potential to improve performance of a trading strategy and can make an otherwise mediocre trading system much better. Granted, it's a little bit more tricky to code it well and correctly, but it's well worth it. I will be presenting and trading a similar strategy but much less aggressive in my program 5-week portfolio that actually launches tomorrow. See the link in the description for more details if you're interested. Going back to this trade, buy setup got generated on the day that I just highlighted with the vertical marker, where the strategy doesn't enter at close, but rather places a limit order below the market with a view to get the better price. The limit order got filled on the following day, so on this bar that I've just highlighted, and a long position got open. The exit I conducted this particular test with was a simple exit when the current day closes above the previous day's high, which took place on this particular day. Exit got executed at open of the following day using market on open order type. If I just zoom out a little bit, you'll be able to see that this trade could not have possibly had a better timing. This strategy managed to pick a major market bottom following the major fundamental event that took place in the beginning of 2020. And this is precisely where, if one is not careful, a mistake can be made by picking this strategy for live trading by looking at its returns in isolation and also looking at its individual trades. Yes, the strategy managed to make 105% in this particular month. However, in order to be able to assess its performance, we need to look at its risk as well, which is where many inexperienced traders get it wrong. As I said in the beginning, they tend to look at the profits of strategies in isolation and fail to look at the risks involved. The way I look at the risk of trading strategies is by using a technique called Monte Carlo. Let me just go back to the equity curve to explain what Monte Carlo does. This technique helps to simulate the randomness or the uncertainty, which is what we face when we start trading a trading strategy live. Strategies backtest results and its equity curve that we see when looking at its results and the equity curve on this screen are both based on one particular order of trades, the backtested one. However, in reality, this is not going to be repeated ever again, as obviously the future will be different. Monte Carlo simulates this by shuffling the order of backtested trades and randomizing it, which is a great way to assess the risk of your strategies. What the Monte Carlo does is that it takes the trades and shuffles them around in order to simulate what the other possible outcomes of the strategy may look like. So, for example, it takes trades that generated this huge run-up in the equity and moves them to a different place. So, for example, somewhere here, and then it takes a bunch of losing trades from here and moves them here, for example. The whole point of this technique is to simulate different possible combinations of backtested trades and their outcomes. The Monte Carlo tests hundreds of such combinations where logically each combination will result in different profit and drawdown figures. Let's have a look at the Monte Carlo results of this strategy that generated this 105% profit in a single month. The results demonstrate very nicely that the increase in return potential in trading is almost always accompanied by the increase in risk. What this table shows are the Monte Carlo simulation results of this strategy. In short, if we just focus on the 5th percentile on this table, we can see that its corresponding maximum drawdown is at just shy of 60%. Now, what this means is that across all simulation runs that the Monte Carlo simulation conducted, 5% of them would have generated at least 59.9% drawdown. Now, obviously, 5% is a relatively small chance, but this is the number I work with when testing my strategies, as I generally consider myself to be relatively conservative. I don't just look at the profitability, I look at the results of Monte Carlo analysis as well, where I look at the 5th percentile drawdown figure, such as the one on this screen. The takeaway here is that you simply can't be looking at the profits of trading strategy in isolation. That's simply not good enough. You want to assess its risk and put it into the context of the profit potential. What I showed you today is a technique that I use myself when validating trading strategies, so the Monte Carlo analysis. And since the maximum drawdown at the 5th percentile is almost 60%, I decided not to implement this strategy in my live trading and continue looking at its different lower risk variations. The reality is that most beginners would actually pick this particular strategy as it's made over 100% per month, where in reality that performance may never be repeated ever again. Instead, what may happen is that the strategy, shortly after it started being executed live, will get into a drawdown. Based on this table here, the drawdown may even be 60% and still be in line with the characteristics of this strategy. 60% drawdown in reality is something that's simply not viable, and I personally think that very, very few people would be able to endure a drawdown of this size. Thanks for watching. David at Critical Trading, signing out.